Welcome everybody. In this video, I would like to teach you how to do basic fundamental analysis using growth, volume, and health indicators. But before that, I would like to dedicate this video to my first subscriber, Ember. Hope you watch it. So yeah, let's get started. First, we're gonna find the 5 basic metrics for a business, and we're gonna use scraps. You're gonna have it in the red paint. Revenue is basically all money earned from selling products and services. Cash from operation, the money that core business actually brings in after paying day-to-day operating costs, like workers' wages, material, and other stuff. Net income, the company's total profits after all expenses, taxes, and interests. Capital expenditures, money spent on long-term assets like equipment, buildings, and technology. Free cash flow, cash left after operating costs and investments, money available for dividends, paybacks, and growth. From these metrics on, we can adjust our growth fields indicators, and let's get to them now. Right now, we're gonna find 3 basic growth metrics, which is the average estimate annual growth in next 2 years for revenue, EPS, and cash from operation, or CFO. Well, we wanna have the revenue average estimates for next 2 years bigger than 10%, CFO for next 2 years bigger than 15%, and net income bigger than 15%. Why? Because, well, personally, with strategy use, the growth is one of the most important factor. It determines if company is actually good. You want also generally to invest in the good businesses. What I mean by good businesses? The businesses that are actually able to grow. That's very important that we invest in something that grows. As you can see, Amazon here has positive growth in all these categories, which may suggest that he is a good business to own. Of course, may. It's not yet fully done, yeah? Right now, let's get to the health indicators. Indicator that says us if company is healthy, and we're gonna focus on these 3 ones: the debt to asset, current ratio, and interest coverage. Debt to asset shows what percentage of company assets are financed with the debt. The lower, of course, is safer. Current ratios measures if the company can pay short-term bills using short-term liabilities, usually around the year ahead. Or 12 months, the next 12 months, basically. Interest coverage shows how easily the company can pay interest on its debt using its earnings. Higher means less risk. Debt to assets, let's say we want to have it below 40% or something around it. The current ratio, if it is above 1, it's good. It means that company makes enough to pay for its like workers and staff for the next 12 months, which is very good. They don't need to take a debt to pay for their ongoing, let's say, liabilities. Interest coverage above 3, which means that their net income is gonna be able to pay for their loans and stuff and interest from it for the next 3 years at least. So the higher than 3 is considered to be very good. PEs and price to earnings are basically a lot of metrics that they are widely used by a lot of investors. I have nothing against them if you buy on the local lows or when you buy in the middle of diagram, so not when necessary company is in this middle sizes expensive, but when it's below its medium price, it can be considered like a buying signal, but I believe there is something a little bit better there. And in my opinion, that better is price targets and price target upside. As we can see here, they are made by professional Wall Street analysts. And usually when there is more analysis behind the stock, it's better. So American stock are good for this kind of metrics. The Asian stocks are cannot be that good because sometimes there is a lot of less coverage and less people get involved. So these metrics can be a little bit tricky. So that's very important to always check who is behind these metrics. As you can see here, analysts recently, that purple line, lifted the price target of Amazon from $280 to $316, and meanwhile the price collapsed, which means probably that there is underlying value there. Usually they raise their price target when they have a good reason to it. And in Amazon case, yeah, business is still growing, it's a good business, so there may be a reason. Price target upside is basically the same value, but it's deducted in the percentage wise. So what is the percent difference between price and price target? Usually the wider the gap, of course there is sometimes even the reason for that, but usually it is considered as the signal to entry. Is it in that case? Well, let's take a look at all indicators right now all together. So from beginning, Amazon, here we have all the numbers, the most important, the revenue, of course, capital expenditures, they are kind of high because Amazon like to reinvest in itself. The cash from operation is rising, net income is rising. In last year's address, okay, from this we can actually deduct that positive numbers are actually growing from the higher numbers. So as we can see here, we have all metrics done well. Actually, the revenue is growing more than 10%. The CFO and EPS are growing more than 15, which for us is absolutely fine. Price to price target, as we can see, there is a divergence between price target, 35% divergence. That's what we're showing you recently. PEs to PEs ratios, PE is below its averages, definitely below. PE forward is also below. Price to sales is also in like the middle or below its local averages. We just consider it good signal usually to people to buy. And our metrics that are responsible for the health of the business, the debt to assets of 20%, well lower than 40, the current ratio 1.05, just a little bit above 1, what you like, that's good, and interest coverage of 35%, well above 3%, well above what we usually like. So in essence, as you know, probably if you watched the previous video, I invest in Amazon. I believe in this company long term. I wanted to give you my basic fundamental tools that I use to define if business has a growth potential, if it's healthy, and if it's reasonably valued. That's just the basic analysis. It's not full analysis. You need to reconsider the mode, other stuff, and even more like reading the reports and stuff. But this metrics itself gonna help you just to like kind of start doing something on your own, to start doing research on your own, and that's why I will like to do this kind of the guide for beginners, I believe. Yeah, I think these metrics that I use are reasonably good and they're gonna be useful for you. And yeah, that site that I'm using for it, you can use this sign the same way. It's absolutely for free. You don't need to have premium version to do this analysis. And I recommend it because, well, it's for free basically, and you have access to a very good tool to do nice analysis. So yeah, here you have one more time the metrics that I like. We have the revenue, TEV, net income, debt to asset, current ratio, interest coverage, PE, and PE is there just below the average of the stock basically, so you don't get a little bit confused. Of course, there is more, but I'm planning to do the separate video for other type of analysis, for other like indicators that you can use to optimize even more of your investing. That'll be all for me for today. Thank you for watching this, and I hope you're gonna like this video and you're gonna leave a like and subscribe. And see you in the next one. We'll see what we're gonna do. Bye.